Hi, this is George. In this week, we are going to see an educational video. Before getting into the video, please do subscribe to this channel if you are not subscribed. Also, please do join our Telegram channel and please like the video if you genuinely like it. Let's get into the video. So this week we are going to see about SIP versus DIPS. So SIP is nothing but systematic investment planning, and DIPS is something like whenever market falls we invest. So this is kind of a not a trading education video that we're going to see for this week. It's based on like mostly on investment type. So we are going to compare between SIP and DIP. So SIP is we are investing the same amount at some interval of time over a period of time at same intervals. Yes, it is usually like in a mutual fund or something like people put like every month, 5th of every month or 2nd of every month, around 10,000, 20,000, whatever amount to this specific fund, maybe a large cap or small cap or mid cap, whatever, for maybe 5 years or 10 years, whichever time frame the investor is choosing to opt. That is nothing but SIP. So most of the people, the retail people who doesn't look at the market, who don't know what market is, they generally tend to go to SIP because they don't need to know anything about market or anything. They just need to believe on some reputed company and reputed fund, and they just need to invest their money. But dip is something like whenever market is falling, say suppose a person who actively trades or who actively keep a watch on market where it is going, so he'll come to know like, okay, now market is in the peak. When it comes down, I will invest. Okay, now market has come down, let me invest. Or maybe I can wait for some more time, let it go little more down. Or he can come up with any decision based on his observation on what he sees in the market and how he feels or predicts about the market in the near future or over the long time. So that is nothing but dips. So in this video, I have taken Niftybees as an example because data will be very easier to compare, because if we go for a stock specific or something, then I don't have the dividend data and the like. I am not putting those things, and or even split or a bonus that they would have given. So Niftybees is a simple thing that it's an ETF. So it is like trading for last more than few years. Now I have taken for the last 5 years of data, and I'm just in this video, and also not including taxes, because when dips taxes are not considered in the sense, maybe if you are like exiting, suppose if market reaches high, then maybe capital gains will come. But anyway, I'm not exiting in this video. But in general, even if you want to do for your purpose, you can do that. But I'm not going to include those things and all. And this is only purely for disclaimer, like educational purpose. This is the disclaimer. I'm not giving any suggestion or anything based on this. So if we are going an SIP, the basic rule is like we are going to invest 10,000 rupees every month in Niftybees for the maybe last 5 years. And if it is a dips, then we, in my personalized rule, what I'm just saying is like whenever Niftybees value drops by 10 rupees from previous high of where I invested, after I invested, market would have went high, and from there, if market comes down to 10 points down in Niftybees, I will invest further. So that is the only rule that I'm going to have. Now with this, let's see what will be the results between SIP and dips. So I have put that in an Excel sheet. So you can see like August of something. Now we are in August of 2022. I've taken from August of 2017. So every month we are putting 10,000 here. This is SIP, and Niftybees value at the time of August to 1 of 2017 was somewhere around 104. I'll just show you from where I took this data. Okay, so this is the normal Zerodha chart. So this is Niftybees. I've taken weekly chart. This is the candlestick pattern. So you can see like July, this is the candle of July 31 getting over that week. So the next week starting, so it is the open here and it is the close here. This is the body of the candle. So you can see like market would have opened here, and that week was a negative week. So you can see a red candle here. So market has started somewhere around 103.98, which is nothing but 104. So that is what I have given here in this Excel. So if you are investing 10,000 rupees on 104 rupees Niftybees, then you would have got 96.15 units of Niftybees. As you cannot get like in fraction, so you will be getting 96 as integer part. This is not like rounding off figure. If it is 97.56, again it is not 98, it is 97, because you cannot buy like more than what you have. So with 10,000 maximum you can buy was 97. So I am giving here 97 maybe for the next month. So similarly for every month for the past 5 years, if you have done, we would have accumulated about 4,697 units. And here and there, we would have not collected some money, like if you see the integer part, something will be left. So maybe I have added, like for rounding off, 4,700 is what I have given. And every month it is like 10,000 from August to till now. August till July it would have been perfect 5 years of 6 lakh. Now it is like more than 1 month, so 6 lakh and 10,000 you have invested. And today's price of Niftybees is 190.7. It was on August first week, it was 190. Now it is 190.7. So total value comes out around 8 lakh 96,000. So if you have invested 6 lakh and 10,000, it would have become 8 lakh and 96,000 in Niftybees alone. Now say suppose if you are someone who thinks like I can invest in whenever market is dipping. So as I told, like only criteria is like 10 rupees down from the high of the previous investment. So you see like same thing in the August 2017 we have invested Niftybees at 104. Now we can see like after that market kept on increasing. You can see like here is the 1 month where we can see market has coming down in the month of March. Even February it has started coming down, but you can see like here it is 114, but you can see 104 was achieved only in the month of March. You can see the date here, 19th of March. So what we generally do is like, so you have invested 10,000 rupees. Now these months and all you are just having the money in your pocket, you are not investing. Only in the month of March. So now you have 70,000 premium because the 6 months you have not invested anything. So the entire 70,000 you are going to put return when market comes from like 10 points down from 114. As we saw, like it is 101 from 114 it comes to 104.5 or 104. So that time you're going to invest the bulk of 70,000. Similarly, you can see the next thing it has happened only in the month of October. You can see from 104 again market went kept on rising up, and once it reached a peak of 124 something around that in the month of September. In the month of October you can see like market went to 114. That's what I would have given here. Similarly, if you see, if you do keep doing this, you can see like once we come to from last year, like 2 years back from COVID situation, market was very violent. So that you can see like here and all, you can see like market has not went. So either it has went kept going up or kept going down. Not no much fluctuation, but from this you can understand like how much I keep on investing every month, which means like market is keep on going up and down, going up and down. So if we do, even if we keep note on market that minutely, and if you invest, you will be able to generate total units of around 4,552 for rounding off. I have given 4,555, and you would have last invested in the month of June. After that, market is keep on increasing now for the last 2 months. In that case, you would have got value of 8,68,000, and 20,000 is still remaining because you're not invested. That comes around 8,88,000. Still this amount is lesser than what you have done in SIP. So in general, what my advice would be, like as we won't be able to time the market perfectly, it is always better, even in the COVID time, before COVID when markets has spiked so much, and after COVID when market was like during COVID when market fell from 13,000 to 7,000, then again now it is rising to 18,000, 19,000, and again it went to 15,000, now again 18,000. No matter what, if you keep on investing in SIP, systematic investment plan, you will always have a better edge over a person who keep looking and doing. Otherwise, you have to have so many rules, and if you keep monitoring, and if you have so many adjust, like kind of okay, I'll close it now when it is at high, I'll reopen it with more per amount or whatever, so with different rules, then maybe you can go for dips. But or else if you are a normal retailer, it is always better to go with SIP. That is what every like mutual fund advertises, so that they get money. But leave about mutual fund or anything. If you are not comfortable, or if you feel like you are not going to believe in any of the mutual fund or anything, it is always good if you yourself also invest in any of these ETFs, whichever you think is the best in your point of view, and you can like do a kind of every month starting once you get the salary or whatever. You can invest without paying a commission or anything to mutual fund, and you can invest from yourself, and still you can get a better result than a person who keeps watching the market and invests on dips. So that is the main thing that I want to say in this video. So hope you would have understood what I was trying to say. Again, in the next week, we will come up with something else. Thank you.